right, what a start to the week. We got some volatility today, so I'm going to break down what this volatility looks like relative to what an actual intermediate pullback looks like to see, are we on there? Was it a little bit too much of bearishness today? Does that have an impact, especially in the very short term? Like, what can we expect tomorrow and Wednesday out of today's selling? And when will the floodgates break? Considering, I know it's a sensitive topic with the floods going on in different areas. We're even getting some flooding in Utah here today. But at some point in time, we've had just these little bouts of volatility where some water has kind of creeped through here in this NASDAQ hole or in this Dow Jones hole or this Russell hole, but we haven't really had the full risk aversion across all asset classes. Bonds have started to pick up. The dollar has been picking up. Gold has been kind of holding lows. So, when will that dam break and we get that vol? So I'm going to break that down in the video today. And we're also going to take a look at a stock that kind of is a good example of what we're expecting to see on the broader market as a whole, especially in the Russell 2000, and this idea of stocks or indexes that don't have a very good margin of safety and their potential to have more weakness than what we see in some other areas. And we'll take a trade on that for today. So let's go ahead and get started. Today is Monday, July the 19th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. As you can see, the S&P 500 dropped, dropped down today. We're going to talk more about that here in a minute. Dropped below its 30-day moving average. The intermediate line crossed below its market sentiment line and crossed below 80. Though remember, bullish territory is anything above 60. So it's actually still in a bullish territory, even though it's got this weak bearish posture right now. As a result, you get this light pink shading and yellow line. We've gotten this before. And, with a very small dip below the moving average, because that's, relatively speaking, I think that's only about it's even less than 1%. Let me just check to be sure though. So 30 days simple moving average. Yeah, we are less than 2/3% below the moving average. So that can lead to bounces like this, or like now. Granted, I'm not advocating. I don't think we're going to bounce up for even that kind of that was one big options expiration cycle long near-term rally, which is rare to be that long. But still, I don't think we'll be that. I don't think we'll get that kind of a bounce. But I do think short-term sentiment's bearish, not extremely bearish. It was for a good chunk of time. You notice we didn't close at the lows of the day. At the lows of the day, we were pretty bearish there, but we didn't close there. So we've got oversold short-term short-term sentiment. The near-term line and the momentum line both down in bearish territory. The near-term line down to its lowest level that we've seen. The last time we saw it this low was back over in this area, and you see kind of what kind of bounce it had off of that. Again, when you were close to an intermediate pullback, but didn't quite have one there. The intermediate line never did dip below 50, much less below 40. See, I got that red dotted line there because that's the key level of when you actually are in an intermediate decline. You end up with dark pink shading and a red line there on that. So there's a really good chance here that we bounce right up. There's a lot of other factors too we'll talk about here in just a second. There's a really good chance that we can bounce up here as early as tomorrow up towards where today's open is at the very least. So something to keep an eye on there. If you take a look at some of the others, like the Dow, that's a little different. The red line now is red. Like, it's not yellow like it is in the S&P. Because it's still rising slightly, it's actually dropping now. So you got red line. Remember, the Dow came really close to its own intermediate pullback. It did dip below 40, just never did get below that 23% retracement because that gap is so big. We've been bullish for so long, it makes the noisy gap so big. The NASDAQ composite, you can see here. Let me activate these drawings. The NASDAQ composite has had its two intermediate pullbacks. Very, very minimal, about as minimal as you can be, but it's had these two intermediate pullbacks here during its seasonally bearish times of the year, February, March, and May. So that's very typical. Again, very marginal. They both dip below 40, and looks very similar to what we're seeing on the S&P. The difference here is we are well above the moving average still. Again, shows how bullish NASDAQ has been. And you got a strong bullish posture still. The intermediate line is still above 80. So we're still not even close to a pullback mode there on the Nasdaq at all. This is just kind of exhale mode. There's where we're at. You can barely see where we're at right there. It's right there. So we are still above the moving average. We're still dark green shading the green line. Much different story in the Russell. So the Russell is getting a cluster, an oversold cluster. Hasn't got one since way over here, and that was the low point. That was the end of that intermediate pullback that started in that we had in September. Remember, its intermediate pullback ended here. The S&P 500 continued to another low here on Halloween, whereas for the Russell that was actually a higher low point on Halloween, and didn't bring the intermediate line down below 40 like it did on the S&P. We didn't get as bullish. See, if you go back, if you go back here on the S&P, notice we weren't nearly as bullish either. Like, we got above 60, but we didn't get above 80. The Russell we did. So we had a much stronger bounce off of that low point on the Russell, and then the pullback wasn't nearly as bad as it was on the S&P. See, the pullback got us back down to well below 40 and back down to bearish pullback territory. So we had our low point there a little earlier, but we had a cluster there, and now we're getting that's the last time we got a cluster on the Russell. I mean, you go back, to the last few times we got clusters. Your clusters on the COVID. Even with that initial cluster, there was a little bit of a bounce coming off of that cluster while we were well below the moving average. And then you can see these clusters over here. The clusters there being the low point, the clusters there being the low point for the small cap index, and then of course the 2018 where we just kept going down, 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 down. Multiple clusters there, and you can see the clusters being the low point there during that regular intermediate pullback. So there's an opportunity that we could be setting a low point here for the Russell 2000, especially kind of flirting with that 23% line that this is the third time now we're flirting with that 23% level there. Last two times we bounced off of that quite a bit. This one not so much. This one quite a bit. So this time we're actually more bearish now than we were there, because we weren't anywhere close to a cluster on those two, and we are now. So and we are well below the moving average. You can see the moving average is a lot higher now. If I go back to where the moving average was on both of these levels, the moving average is actually a lot higher now. So we're actually well below the moving average. We are in intermediate pullback mode, but keep in mind, like I've always told you, and I don't think that I think we're gonna stay in intermediate pullback mode. And I told you about how important it is for the Russell to either break or hold this level here, because there's just no volume below it, and I think that that's what breaks the floodgates. Because of that, I think there's an opportunity that we bounce here first before we open the floodgates. So I think that we will kind of bounce off of this level. And you remember how I say you get your biggest down days while you're below the moving average, especially the further below the moving average you are, you get your biggest up days. So you notice we haven't had one for a while. We've been below the moving average since if I go back to September the 2nd, you can see we were below the moving average right there. We started to have we had that big update there on September the 1st. Then we went below the moving average, and you can see that big strong move on September the 9th. And then we've had all this selling again. So I expect that we'll get another big strong move, and it will look like we're bouncing, and here we go. But I don't believe that this next one will be enough to get us back to being bullish again. But I do expect that we'll get a good, nice bullish bounce off of these levels, off this Fibonacci level, off of this cluster, and off of this S&P. I just think off of this light pink shading yellow line, I just think it'll be a very temporary bounce. I don't think this is a kind of a permanent buy the dip scenario. I think this is a very temporary buy the dip, and we might actually gap down first tomorrow morning before we get that bounce. So I don't think we're necessarily like taking off here. From the low of today going into tomorrow. We could very well open up down below today's low and then rally throughout the day and filling in the gaps. So that's kind of what the market forecast indicators are telling us on these different indexes. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. Number two, it tells us you want us to do another video. So if you like our videos and you want to let us know, you can do it right now with one click. If you don't like our videos, you don't have to click on anything. You don't even have to watch. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. You get free subscribers get a special offer to check us out. So make sure you subscribe to see what that is. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. You can also see another place to subscribe to our site for free is right up here at the top. Just click on that blue button there. If you're watching us on our blog, check out some of these things on the right, including our Market Outlook live videos where I review all the trades I do in these videos. I tell you when I close them, how we manage them, all of that. So I post that. I also put on today's trade idea already before the market closed, the one I'll do at the end of the video today. I put that on during that live video. You can get there through here. You can also get there by coming up to live trade review right there. These are upcoming trading rooms that we have coming up this week. All of our subscribers, our paid subscribers, get access to all of our trading rooms and our Market Outlook Lives. Of course, our premium subscribers get access to it for cheaper, and our premium subscribers get access to other things like our class forums as well as our premium resources. Come down here, click on this heart. It opens up a new tab. Click on that like button right there. Also, click on this thumbs up icon. Opens up another new tab. You can hit that like button there as well. Again, the more you do that, the more people will see our content. That's why we always ask for it, because that's how these platforms work with our algorithms. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, now let's take a look at some other charts here. So bear with me while I bring those charts back up. And let's take a look at the long-term chart today. So here is that long-term view. You can see we're finally getting a bearish candle here. So we kind of bypassed the transitions, went straight to a bearish candle. The high is the open, and we are well off of that high. So we're not threatening getting an upper shadow here anytime soon. But you also know we haven't got the red arrow yet, which without a red arrow, you don't have an intermediate pullback, at least on this chart. So obviously that's not the case for the Russell. The Russell is getting a lot more bearish. You see how it's flirting with that 23% line again. You can also see how its PPO is really dropping sharply. The NASDAQ not even more close to its 23% retracement level or its moving average. So it's really kind of a tale of two different markets. The Dow is giving you another red arrow. So that's kind of an interesting little development. And within the Dow and the Russell, how we're getting obviously much more with the Russell. They're getting some bearish moves here. If you look at the 3 green arrow chart for SPY, look at that big spike in volume, 147 million shares trading hands. The range today, 9.5 points. 3 red arrows, so big moves. You can see the MACD dropping sharply. We are below the moving average. The stochastics dropping sharply, but both those still in bullish territory. We're still above 0. We're still above 60. So we're actually still in bullish territory on these lines, even though we're really diverging away from their moving averages. So very similar to something like that there. And you can see, very similar type move. We got down and made a strong move below the moving average and then pop right back up. I don't think we'll pop back up with that kind of move though. But I think in the very short term, there's a very good chance that we pop back up again. That's SPY. IWM, of course, much different story. But look again how extremely low we are. And when we had that type of move, when we got really extremely below the 8-day moving average, and we had an open red candle, then you see what happened the next 2 days. We made a move back to the 8-day moving average. I see a very similar type of move occurring again here on the Russell 2000, considering how extreme the move has been. If you take a look at like the directional movement index, we are getting more bearish. It's pretty strong on the negative side, but not as bearish on the positive side. So we're still not below 20 on the positive there. And if you look at IWM, we did hit an extreme. Like, look, we jumped up above 40. That's a pretty extreme level. You can see that was the most extreme that we got there. Now, it wasn't the peak, but it was the most extreme that the bullish indicator got, and when that basically started this run. And you can see how we had some weakness for a few days because we were so extreme. And same thing. I expect that we'll get some weakness in the bearish trend, so a bullish move over the next few days to consolidate some of that extreme. But I don't think that we're in. I think we are in pullback mode right now on the Russell 2000. Obviously, you can see it here too on the Russell. I mean, well below 40. In fact, we are now below 30. So kind of an extreme low there that we haven't seen in a very, very long time. In fact, you have to go all the way back. The last time we were below 30 was back there in the COVID era, and before that it was those 2018, and before that it was that first quarter of 2018. So, needless to say, we are pretty darn bearish on the Russell. And you can see we're also pretty bearish on the S&P. Now, again, we haven't dipped below 40 yet. We've made multiple attempts below 50, but every attempt below 50 has been met with bouncing without getting below 40. So I don't think that will be the case in the long term here, but I think in the short term, I think a lot of people will see this. Buying, support and resistance are all psychological. So if a lot of people see the exact same thing here, then they anticipate the bounce by buying at these lows, then they create the bounce that they're anticipating. And so you see something like that. But that doesn't mean, however, because of how bearish the Russell is, that won't eventually pull the rest of this market down with it, like we're seeing today, finally in the S&P. So any bounce we get, this is very, very short term. Very short term, I believe, on the S&P. You can see we are flirting with that lower quartile, just a smidgen, but you see how much support there is below us. So I mean, we're not going to break that support in one move. It's going to take some up and down, and we're going to have to pound at that thing for a little bit before it gets going. The IWM doesn't have that issue, right? There's no support below us, so that's why I say once this has its free fall. Once it breaks that level, it's going to open the floodgates for everything. And so I think at first, though, we'll come up here and test that volume node up around 220, 222, 3, and then roll over and really break the floodgates there. All right, and you can also see it's been in this lower quartile for quite a long time. Let's take a look at today's intraday move. So here's the fascinating thing. There's that runaway gap I told you. So a runaway gap being you gap down and then you don't fill it in because we just go right away. That also had potential for a runaway gap, but we filled it in immediately. So that took the potential away immediately. But when you gap down by a significant amount, which is what I tweeted out, I mean, that's a pretty decent, almost 2 standard deviations gap to the downside. We didn't finish, however, with a close below 2%. So keep that in mind. That's not a very bearish close. In fact, that's a pretty decent opportunity to buy the dip, especially when you look at the range. Let's see, there we go. The range today, which was, again, 9.5 points, the volume 147 million. Both of those marks are extremes, right? 9.5 points is well off the chart here for the average. 147 million, well off the charts for the average. So both those numbers are very high, very extreme, and when we've seen in the past when we've had those types of extremes, the market buys that up pretty quick. So, and again, I don't think that's going to be a permanent buy the dip. I don't think we're going to get that kind of move going into August expiration, but I do think that the market will take advantage of the extremes, and you see that in the volatility too. The volatility jumped up right off the bat to this 95% level for resistance, and you notice it stayed there all day, even though the VIX was trying to climb slightly higher. It stayed right around 95% before pulling back. So look for it to pull back probably towards this 85% mark, then hit a low point there, and then make a run up towards 100% and higher, which is when 105 until you get to 105%, it's noise, right? 105% or higher, now you are in intermediate pullback mode, and obviously. This is for the S&P 500, not the Russell, but you get the idea there. So we are definitely in pullback mode, so to speak, right now on the Russell, and we're not quite there on the S&P on the S&P yet, but you can see we're getting there. I mean, that's a pretty big jump in volatility, and we talked about how this is the seasonally bullish time of year for volatility. We just climbed up that much that quickly, but again, look for a drop here over the next few days till September, July 21st, which is actually 2 days away from now. Don't be surprised if we don't. I mean, now granted, that's very specific, so hard. I mean, I hardly do expect it to perform exactly the same way all these ups and downs are, but you can see how it's kind of lining up. I mean, this is a bullish time of year. This is earnings season, so it's a bullish time of year for us to get a drop in volatility. But then it's a bullish move, or a bearish time of year for volatility. Excuse me. Then we expect to get a bullish move here on volatility, which is typically bearish for equities when you get these bullish moves in volatility. All right, I'm going to break down the rest of these asset classes and how they move today and how that influences equities and our trade idea of the day. But before I do that, just to summarize this technical outlook, I mean, we are in pullback mode on the Russell 2000. We are looking even more so on the Dow. It's a price-weighted average. We're not there yet on the NASDAQ or the S&P, and especially not on the NASDAQ. So we're not close. Now, can we get there eventually? Yes. I think at some point in time, that drop on that major support level on the Russell will open up the floodgates for everything. But today was so extreme that I wouldn't be surprised if we don't pop back up in the next day or two and consolidate some of this bearishness. But any bounce, any buy the dip bounce we get will, in my opinions, just be temporary. We are so far below the moving average. We are so far down below the 8-day exponential moving average on the Russell that it's going to be hard not to pop back up, just to get back to those moving averages. And as I said before, when you're below 30-day moving average, you get your biggest bullish moves. So don't be surprised if tomorrow or Wednesday we get a really strong bullish move and gets a lot of people thinking, okay, we're okay. But I don't think we are okay. I think we are in pullback mode. I think it's going to eventually break the dam on the Russell. It's going to lead it to everything else coming down too. Because that's the time of year that we're in. Like, we are in a time of year where volatility rises. It's already up to the mid 20s. After maybe a little pullback back down to 20, maybe back down to 18, 19. Look for it to eventually work its way up to pullback mode on the VIX, and eventually that will be a great thing for us from a 1-year standpoint, return standpoint. But it will be a really significant time of volatility in the short term, and more so than for some more than others, because so many investors have gotten bullish here really, really late in a very mature intermediate cycle. That to be in an intermediate run for 8 months when the typical time frame is 1 to 3 months means essentially that we've been holding our breath for 5 months and just continuing. And at some point in time, when you hold your breath longer and longer and longer, you hold your breath. At some point in time, you just have to exhale, and then you really start breathing in and out, in and out. And that's kind of what I'm expecting to see here on the market. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know what charts or indicators you're looking at that tell you why you're either a lot more bullish than I am or a lot more bearish than I am. All right, now let's talk about how these other asset classes perform today. So give me 1 second to pull up my asset class comparison chart, and let's just look at just today alone, because OPEC had a big factor on commodity prices and on crude oil especially. So let me get up here and we'll go down to this 10-minute chart. Look at that big drop in commodities. DBC down 4%, long-term bonds up 2%. So big jump in long-term bonds, which had already been bullish, right? And then you can see the gold and the dollar both up, and I told you before that's risk off when they both go in the same direction. And then you can see the weakness with QQQs holding up the best, and I expect that will continue to be the case. We've been looking at this chart for a long time, QQQ versus IWM, and we are in bullish mode, and I think we'll start to slow down. I think that MACD histogram has peaked. I think the MACD itself will peak now, and I think we'll start slowing down. I don't think we'll necessarily go down, but we'll start to converge on these lines. But first, the divergence has to slow down. The divergence has been going up to really fast speed, so that divergence where those lines separate away from each other, that has to slow down first. Then we have to converge without, towards the moving average. Doesn't mean we have to break, but we'll just have to converge. All of that is bullish, for QQQ over IWM. So there might be some weakness here, but just simply from, it'll be a slowing down of this, and I still expect Qs to be much more bullish than IWM going forward. You can see what the trend here look like today. Big jump in the trend. Of course, it was really big on Friday, so we had a big couple of days here on the index, and it was starting to ramp up the 20-day average there. And then of course I've shown you this chart before, but if we take a look at how the sectors are rotating. But first, let's take a look before we look at the sectors on how these different asset classes are performing. So give me 1 second to bring that up. Where is it? So here is how all the different equity asset classes are performing relative to VT, which is a broad U.S. and foreign market ETF, and you can see over the last would be 13 weeks where the strength and where the weakness is. There we go. There's the mid caps, micros, and small caps all going down to the left. Emerging markets have been weak for a while, but they've been gaining momentum. They're not getting relative strength yet, but at least gaining momentum and crossing above 100. And you can see Qs are going up to the right. So there's the strength in the Qs and the weakness in small caps. I expect that will persist, and not very much movement at all in EDFA one way or the other. It's just kind of sticking right there at 100 and 100. So not much relative strength or weakness, really matching this broad ETF that we're seeing here. Let's take a look at the value and growth. So let's come over here. And you can see here are some, value and growth. Where's that at? Come back. There it is. Value and growth. There is growth going up to the right, and there is value going down to the left, right? And that's over the last 5. Let's look at 3 weeks. So look at that. That's the kind of market. I mean, those stocks have been so bullish, and these have been bearish. Again, this doesn't necessarily mean that we're going to go up, but it just shows where the margin of safety is. It's in these growth, large cap tech names that will hold their value better, that will outperform by just holding their value better, whereas these other areas that are more correlated with like the Russell 2000 have gone up so far so fast and have a very poor margin of safety. They have the most to lose, as we saw in that Russell 2000 chart. A lot of them influenced by what commodities are doing. So let's take a look at the commodities chart here, DBC, and you can see like we're turning dark red line well below the moving average, and we're flirting with breaking below 50 and eventually below 40. Very bearish short-term sentiment there, down to the downside. If you take a look at like TLT, you can see the big bullish move we had there up to the 62% retracement level. Big extreme move. In fact, if you look at its DMI for TLT, you can see that, again, we've already had the big spike up above 40. We're getting another one here, a little bit of a divergence. So again, I expect that divergence to play out in a kind of, again, a little bit of a drop, short-term drop on the Russell. This is because we're so extreme. You can see really highs, really strong highs here, extreme highs above 200, above 70, but lower than the extremes we just saw a week or so ago, but much higher on the index. That just screams extreme, and extremes wanting to come back down. A little bit of resistance up there too, wanting to come back down and fill some of that volume in this area before working its way. I don't think by the time we finish its rally, it doesn't have too much further left to go. Remember, the equities have really been lagging behind the moves in the bond market. You also see the dollar has also made most of its bearish or bullish moves. So it doesn't necessarily, you can see how it doesn't have to keep going up for the risk aversion trade to get going, as you saw today. So because the dollar has already made most of its run higher, bonds have already made most of their run higher, and now equities lagging behind the three, you would expect that they'll make their run lower now. Again, just exhale moves, right? Nothing, long-term trends are still well intact for all three asset classes. Bearish for the dollar, relatively bearish for bonds, and then bullish for equities. All those long-term trends still intact. You can breathe out without changing your physical state, right? From being healthy to sick. And that's what we're doing. We're still healthy in the long term, but now we're just exhaling because we've been holding our breath for so long in this risk aversion trade, especially in the S&P 500. Now we're finally seeing the exhales permeate from one asset class to another, eventually getting to, and again, commodities being the most lagging behind. So you can see like what equities are doing, and finally the commodities are finally following suit, being the most lagging out of all those asset classes. Now let's take a look at the sector moves, and you can see the sector rotation chart for just today alone, right? So let's go to July and July 19th. And you can see how things move today. Staples holding up the best. We saw that with a lot of those kinds of stocks. Kroger having a really strong move. You see technology, discretionary communication services down, but not down as much as some of these of their peers. Financials, energy, materials, industrials, all down the most. And we've talked in the past, they're the ones that have the most to lose because they've had the biggest gains since that September 24th low point back last year. They've had the biggest gains, and now they're starting to consolidate some of those gains back towards where the rest of the market is. And these don't have as much to drop because they don't have as much to consolidate back towards where some of you can see where utilities and staples are, and they obviously will tip what you would expect them to do the very best during any kind of risk off type move. Let's take a look at the 12 grid, and when we talk about like, are we in pullback mode? If you weren't looking at like these three up top, you would think we were. Right? I mean, look at that big drop in financials and industrials and materials and in energy, way down, so extreme. You also see why it's going to be really easy to bounce up in the very short term. Like when we've been extreme before, we've bounced up off of these lows. You can see the bullishness in utilities, real estate, and staples. Very strong bullish trends right now. Healthcare to a degree as well. And you can see the light pink shading starting to show up on some of these cyclical areas. And technology going to work its way there. And that's why the market, these are market cap weight. These are the biggest sectors. That's why the market looks more like the top row than it does the middle row. But it's the middle row that's been so bullish up to that March peak that now we're finally starting to consolidate here. And that's where we expect, this weakness to open the floodgates to a broader weakness, in especially this top row with the safety havens showing relative strength, even if they might be down a small amount themselves during any kind of risk aversion. All right, so for our trade idea of the day, I want to take a look at Urban Outfitters, a retail, which obviously if this catalyst that sparks this risk aversion trade is this COVID decline, you can see that would hurt this particular sector more than any others. And Urban has been sideways for the past few expiration cycles. And you've had some dark pink shading and red lines, so this is hardly new. But if you take a look, we are getting that again now, dark pink shading and a red line. If you take a look at the long-term crossover here, we are getting a red arrow, and you can see that big bearish candle that we hadn't received previously. This is a bigger bearish candle and very significant drop in momentum here, and a significant break of the 50-day moving average by the Hakunashi candle, mind you, which is more significant to have that kind of break on that candle more than the regular candle. You can see the MACD and stochastics, the MACD diverging. The moving average is starting to diverge away from the 30-day moving average to the downside, so you can see the potential they still have to go there, and you can see the stochastics breaking into bearish territory. Both of the lines are flirting with breaking into bearish territory themselves, so almost below 40 on the stochastics moving average, almost below 0 on the, well, actually just a smidgen below 0 on the MACD's moving average there. Taking a look at the directional movement index, and you can see the bearish breakout we're getting, which is different than these other times, because now you do have the negative index hitting a higher level than we've seen, and the positive breaking below, and you can see the ADX with the potential move that it has going forward from here. Also looking at the Bollinger Bands, breaking below the lower Bollinger Bands, and for that matter also breaking below the Keltner channel as well. You can see getting below the Keltner and the lower Bollinger Band with increasing negative momentum, and we still don't have that green dot yet where the bands cross themselves. Probably get that tomorrow. So we haven't had that before either. All these other bearish times, you notice we were above the lower Keltner channel. This is the first time we've been breaking below it. Going back to the trend strength indicator, the other big difference here on this break is we are below the much more below the cloud than we were even over here, and the cloud's a lot thinner now than it was back then. The red line was above the price back then, actually it's a little bit below the price back then. Now it is below that price as well, and the price itself is almost below, the red line, excuse me, is almost below its cloud over there. And you can see we have the beginnings of a weak bearish posture, and we'll see if that, we've had that before, so we'll see if that turns into something more bearish. And finally the RSI and the CCI also hitting bearish levels, getting below 40 for the first time. It's all year pretty much is the lowest level we've gotten all year, and then the CCI also getting down easily below negative 100 towards negative 200. So more of a bearish move than we've seen in a long time on Urban Outfitters. And you can see too, if you saw that in the Bollinger Bands, there's not a lot of volume below where we're at right now. It made this big strong move right here, and it's been so sideways, very similar to the Russell. Look at all that gap in volume. It's very, if you look at the 2 years for COVID, there's the COVID drop. It's even that much more stark, the gap, that volume before we get down to what can be a significant support level down below 30. Around 30 and a little bit below 30. So because of that, I decided, okay, well, let's see if we can't do a long put trade on this and see what we get out of it. That way, if it does bounce up in the short term, we'll lose a little bit, but we've got some room to work with on that long put. So I went to the at the money put, bought at the money put, put a 50% stop order on it. So sold. I have a stop order there at $1.40. So getting in at, what did we get in? Did we get in at 280? Close to 280. I think we got in at 275. So yeah, 50% stop order on that. And so if it does go down, then keeps going. If it does bounce up, I've got some room to work with. There's where the stop order is right now, right around what, $38 ish. So if you look at where that is, like on this short-term chart, we have some room to work with here. There's that stop order. You've got these highs. We'd have to get basically back into the upper half of the chart for us to get stopped out on this trade. You notice today's gap, we already did fill it in, interestingly enough. So we don't have to worry about that, about filling in today's gap. So we might bounce up. I think if we bounce up tomorrow or the next day, we'll probably peak right around 37 and hit some resistance in that volume, and then start to work our way back down if the floodgates break, as we expect that it will for most of these stocks here, and especially for stocks like this that have a very poor margin of safety, very similar to what we're seeing on the Russell 2000. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Our free subscribers have access to that, as well as all of our other subscribers too, all of our paid subscribers. So open up any new threads there with any questions or comments you have about what we talked about tonight. Reply to other people's threads, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, as well as like us on Twitter and Facebook, and comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all next time.